Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital Lending. Joining me today is the man himself, the governor of the great state of real estate here in Texas, Mr. Michael Becker. Michael, how are you?
Paul, doing pretty good. Just coming off the glow of the Old Capital Conference we had about a week ago as we record this. Thought it was a great event.
Yeah, it was a great event because you did a great job with your panel of listing brokers, investment sales brokers, people that actually sell multifamily properties in, let's say, North Texas. And to name the names, you had all the major players in North Texas on the stage with you, that you led the discussion about really what's going on to give people in the audience, and there was 350, 400 people in the audience, really kind of inside information that you pulled the curtain back of some of the things that you're working on, but also listening to some of the investment sales brokers and in what's going on in their lives. And so it was a very dynamic conversation that you led. And I certainly do appreciate you stepping up and being part of the in this case, the 9th annual Old Capital Conference in Dallas in Fort Worth. And so what was your take, Michael, on your stage presence?
Yeah, no, my panel, I thought it was good. You know, two kind of takeaways that come to mind is, one, new faces in the crowd. Kind of noted that when I was there.
I noticed that
three years ago, I probably knew 70% of the room, and this year I maybe knew 20% of the room.
Sure.
So I think that's kind of, nature's healing. So obviously we've seen some dislocation specifically in the typical listener of this podcast or the attendee of the conference, which tends to focus more on the workforce housing space of a segment of our multifamily space. So a lot of new people coming in without all the baggage that some old people have. So I think they're seeing opportunity and are the ones able to take advantage of it. And then the other thing, just kind of on the panel, I think we had 6 brokers, and 3 of them within between the last conference and this conference are at a new shop. So there's some movement and dislocation in the industry that I think comes with some of the cap rates, going up and fundamentals softening. So, seeing some movement in the brokerage world as well, and kind of seeing that. So it's just kind of nature's healing. It feels like we're starting to kind of, come out of this a little bit. I mean, we're not all the way there, and there's still challenges and things like that. But it just seems like, we're starting to see some green shoots that maybe we're not here a year or 2 ago. So those are kind of my 2 main takeaways, Paul.
Yeah, if you've never been to the Old Capital Conference, make sure you get your ticket when it's available next year, sometime in the fall. It'll be our 10th anniversary of the Old Capital Conference, and you'll have great opportunities to network and shake people's hands and meet people. Because as Michael Becker says, get uncomfortable a little bit, get outside your safety space, so to speak, and come out and meet your partners or your future partners and get into the industry physically, not just by watching videos and books and tapes.
Maybe we even get our guests today to drive on up to Dallas for the 10th annual. Maybe we can convince them on the podcast today.
Absolutely. We'll bring out our guests in one second, but we try to have our guests come up because if you're not familiar with Dallas and Fort Worth, Old Capital Lending, we cover kind of the Southwest. But if you're familiar with Texas, obviously Dallas, Fort Worth is in the northern section of Texas. And really the majority of the growth in Texas goes all the way down on I-35. So it starts, let's say, in Dallas and goes all the way down to Laredo, which is really on the Mexican-Texas border. But the growth is areas of Central Texas, huge growth. And Central Texas would be Austin, New Braunfels, San Antonio, and then farther down, all the way down to Laredo. And our guest today, who's a friend of ours, and we've known him for a long period of time, and we trust his voice and what he's saying out there to clients. We wish we could have him on the stage last week, but he was tied up with an event that he had down in the Houston area with his team. We will get him on maybe next year to come on up to Texas, up to Dallas, and talk a little bit about what's going on in Central Texas. But let's open up the curtain and talk a little bit to, I would say, one of the experts of Central Texas, Matt, and then Michael, why don't you introduce Matt, and we'll kind of go from there.
Yeah. On the podcast today, we have Matt Michelson at Newmark. So he runs the San Antonio office for Newmark. Matt, thanks for coming on today.
You bet. Thank you, Michael. Thank you, Paul. I'm
Yeah.
happy to be on.
Yeah. So Matt and I have done several transactions together over the years. So got to know Matt both personally and professionally. So Matt, for those that don't know who you are, it's the first time on the podcast, maybe just give a quick little background on yourself and kind of the Newmark Central Texas team.
Sure, you bet. Thanks again, guys. Yeah, Matt Michelson, I'm Executive Managing Director for Newmark, part of the Central Texas investment sales teams. And as Paul had mentioned, so Central Texas is Austin, San Antonio, and everything in between. Kyle, Buda, San Marcos, New Braunfels, the I-35 corridor, which is going through a huge boom right now. Part of the Central Texas team led by three other investment sales partners in Austin and a dedicated capital markets group. But yeah, our focus is on the investment sales side of existing multifamily, A, B, C class. We don't discriminate. We sell apartments.
Oh, good. Yeah, you're physically located in San Antonio.
Correct. Physically located in San Antonio. I lived in Austin for about 10 years. Got into the apartment business end of 06, early 07 from San Antonio originally. So yeah, live in San Antonio now, help cover the whole Central Texas market, but based here in San Antonio.
Yeah, you also went to Baylor.
Correct.
Which was also in Central Texas. So you're a Central Texas boy all the way.
That is true. Baylor was a little bit different when I was there. We just started to allow us to dance when I was at Baylor, but and now we have a great football team. Who'd have thought? It's been I lived at I-35. I've spent my share in Waco, Dallas, Austin, San Antonio, everywhere in between.
Matt likes traffic, I guess. So he's been on I-35 through the last 20 plus years. So you said in 06, so kind of went through probably like those pretty peaky, right? For the first maybe 6 to 12 months might have been fun. And then you kind of went through the crap like immediately after. And then, obviously we've had a 10 plus year bull run coming out of the back end of that, peaking in, 2022. And then it's been a tough 3.5 years, and nowhere is probably tougher than the northern part. Not that you focus a little more on San Antonio, but Austin obviously has been the epicenter of supply and softness, and overbuilt in the short run with great long term fundamentals, but short run's been challenging as a guy that owns several assets in Austin. Maybe kind of start there. What has your career been? Kind of the ups and downs, and are you seeing any kind of parallels to the market you saw at the very onset of your career to kind of the most recent years?
Sure. No, you're right. It's been I've had been blessed and fortunate to have been through a few cycles, for better or worse, but you kind of learn from all of them. And kind of got into the go-go days in 2006, 2007, kind of when the CMBS debt market was going hot and money was cheap and free at the time. And then experienced 2000, 2008, 2009, and that downturn. Big difference. I'm sure you guys have heard this before, but I think the big difference between, the 2008, 2010 kind of recession is there's so much more liquidity in the market today. Back then, nobody had any money, not just on the buy side, on the equity side, but lenders were strapped. Today, there's a ton of capital on the sidelines, licking their chops to get back into the market. Everybody thinks they're Warren Buffett or wants to be Warren Buffett and quote, buy the dip. Kind of feels like right now, kind of coming off of this last 2 to 3 year kind of downturn, almost kind of feels like back where 2014 to 2015 timeframe, where we're kind of looking at the upswing again. And so really hopeful and optimistic kind of going into next year, and that we're coming out of this thing.
Obviously, history doesn't repeat itself, but it kind of rhymes sometimes. So, the peak on the front end of your career was probably at some point middle of 07, would probably be somewhere in that the first half of 07 was probably kind of the peak. And the trough was probably 2010?
Yeah, so 2009, 2010. I remember living in Austin at the time. I think there was, apart from trades, I can't remember how many trades. You definitely counted on, one hand how many trades there were across the whole market. But I don't think there was any units delivered in 2009. That entire period, it was a really weird time in the market, a lot of uncertainty. But yes, that was 2009, 2010 was kind of felt like the bottom.
And so let's call it first half of 10. When did we get back to kind of the prior peak and like value and things like that? How long did it take from peak to trough back to prior peak? When was that? Was that like 13?
Yeah, 14? I think maybe 2014, roughly. So, I mean, again, coming out, I felt like it was a very different time then. It was almost felt like a darker time, kind of 2010 time frame, 2009, 2010 compared to today. I feel like it's a shorter turnaround today. At least that's what I keep telling myself.
Yeah, I'll keep telling myself that too. So then kind of fast forward. So the peak was clearly Q1 2022. We all know when the peak was. Call that February 22 was probably, if you want to put a pin on it, that was the peak. And then let's call the trough like on Class A maybe now or a year ago. And maybe workforce housing, hopefully now-ish.
Yeah.
And then, I agree. Last time it was like the spigot was off. Like there was no money. Like no one had money. I was lending. Like the bank had money one day and then the next day we didn't. And there was no liquidity and there wasn't like a ton of buyers in the buyer pool and it wasn't strong offers with terms and multiple offers, things like that. So I feel like the recovery hopefully will be a little shorter here. So for the peak was 22, trough is call it 25. Back to the prior peak in 27, 28. That sound about right to you, Matt?
I think so. I think for San Antonio, we're optimistic that it's back half of next year going into 27. Austin may take a little bit longer just from a supply standpoint, but 27 onward is we're super optimistic for.
And what are you seeing between Class A? You saw, the spectrum of A to C. How are you seeing those the various property grades of the multifamily space? How are they differing right now? What's demand and interest and issues and opportunity, et cetera?
Yeah, pretty big disparity right now. I feel like that's the one thing that in a market cycle you see the most gapping out in cap rates probably in the B and C space relative to the A space. There was a time, right, where Michael and Paul, y'all remember back at the peak, right, 21, 22, where Class A, B, and C, they were almost trading on top of each other. Everything, there was no disparity between the asset classes, which, might have been a little backwards in hindsight. But today I think we're seeing the most widening out in the C space, kind of 80s and older. Class A cap rates are still holding strong. I mean, somewhere range bound around a 5 plus or minus 25 basis points. So in Austin, that's sub 5. In San Antonio, you're kind of right at a 5. Austin and San Antonio always kind of trade between 25 to 50 basis points, kind of at that spread, right? Me and San Antonio going to be a little higher cap rates than Austin. I'd say on the 80s and older, we're north of a 6 in San Antonio specifically. Your buyers want and need positive leverage. That's the big difference between that and Class A today. Class A cap rates, people are still really willing to lean in on negative leverage or to a leverage neutral position. Very different than what we're seeing in the B and C space.
Yeah. And then the workforce housing in San Antonio just seems like it's been a little bit of a bloodbath, to put it mildly, where like some of the 70s and older deals specifically in high density pockets. Seems like, I think you have a submarket called Castle Hills. We own San Antonio, but we only own kind of Class A in San Antonio. And it seems like I looked at earlier this year, there was 7 or 8 deals that all were either on the market or just recently on the market, all within a 2-mile radius. So I was like, I got to go see what this neighborhood's like. And those of us that are familiar with Dallas, was kind of like Bachman Lake, but more dense almost. It was this Castle Hills area near the airport. And it just seems like every one of those deals is like a bloodbath. So I don't know if I really have a question there, but just kind of any observations around kind of where the worst or the least desirable deals are and the most desirable and least desirable kind of from a buyer standpoint.
It's not. I don't really want to throw stones or pick on any one submarket, other than I think in any market, San Antonio is not immune. You're going to have certain pockets that are going to be more workforce in nature from a demographic standpoint. But overall, though, you're right, Michael, that workforce space, really 70s and older, but 80s and older in some cases, is very much operationally beaten down. We're seeing increased bad debt. We're seeing increased vacancy. So it's tough. These deals are operationally distressed. They're strapped for cash, and so that makes it tough to maintain a healthy renter profile when the deal's strapped. And so it's kind of becomes a little bit of a domino effect if a couple properties in any one given submarket are are struggling, it's like a rising tide seeks all boats. In some cases, it's the opposite. There's like a couple problem children, if you will, from a property level, then it can impact your neighbors, unfortunately. It's really operator specific, though. That's the one thing I want to harp on. It's not necessarily a one given submarket, but it's operator driven.
Yeah. And so your market's been pretty quiet from the transaction volume, I'm sure much to your dismay relative to a few years ago. When you're talking to potential sellers that are looking to sell, what's generally the motivation behind them today? Why would they choose to sell? I'm sure most of them aren't choosing to sell or having to sell, but what's motivating the today's seller in your world?
Yeah, I mean, you're right. Operations are down, our sales are down across every broker, across the whole market. It's like that Coldplay song. Like nobody said it was easy. Nobody said it would be this hard. It's been telling myself that for the past 2.5 years. But yeah, who's selling today? You have some, quote, forced sales, right? Whether that's pressure from their equity or their lender. And then, so that's maybe capital D distress or lowercase d distress, depending on how depending on the capital stack and how it's structured. So those groups that are maybe they bought at the peak with floating rate debt and they've got a debt maturity coming due and they can't afford the refi options or they can't afford the interest rate cap payment and reserves. So that's one profile of seller. And then you also have some long-term owners that are in the money. Maybe they have a debt maturity, or maybe they just are looking to recycle the capital into something else. We've actually sold 2, if not 3 deals this year between San Antonio and Austin for that exact profile. These are nice Class A deals. The owner was in the money, and they wanted to go recycle that capital to new development because they felt like now is the time to put a shovel in the ground. And so it was just from a liquidity standpoint. Yeah, so that's probably I'd say the two main profiles, but probably more on the former groups that are kind of maybe in a pinch and or have some external pressures to sell.
Yeah. So when you're talking to potential sellers, what are some of the red flags that you see that maybe when they say this or you see that you don't want to take the listing on? I know people might think that you just want to take every listing on, but there's a lot of time and effort and money that goes in for a multifamily broker when they bring a property out and got to drive to the property 30 something times to go do tours and spend a bunch of effort and capital on it. What would make you, take or not take an assignment in today's environment?
Very few listings that we don't take. We want them all. Don't discriminate. Again, A, B, C, big or small. We sell it all. But I would say, look, 2024 was the year of uncertainty. There was so much uncertainty on there were deals we're not making. Both seller, broker, and buyer. Nobody. I mean, admittedly, I think our broker told you they knew what was going on in 2024. They're lying. It feels like now going to 2025, or almost, the back half of 2025, we still may not like where we are. We don't like the pricing or fundamentals, but there's more price discovery out there. People kind of are more accepting of where we are. So all that being said, I just wanted to have, setting the right expectations with an owner or would-be seller up front. We don't want to blow smoke on value, and because we know where buyers are pricing deals, we're active in the market, we know where these deals are trading, and so usually it comes to kind of a price expectation on where we might not either win a listing or might not take a listing, because if a would-be seller today has unrealistic expectations, especially relative, for example, to like their debt balance, right? Those are tough assignments. Those are really tough assignments.
Yeah, Matt may say that he takes them all, but realistically, it may cost $10,000-$15,000 to take on an assignment that eventually will never trade because the expectations of the seller are unrealistic. So Matt has to vet out to make sure that the seller's on board to what the expectations are of the future buyers in the market as of today. Not what they were 3 years ago when they made promises to their investors that they were able to double their money. You may not double their money. They might not even get their money back. But so the investors today that are buying these things, they kind of know the market. Matt knows the market is not going to take an assignment that's going to cost them money to do that. But I want to talk a little bit about, do you think, Matt, that we're truly headed towards a merged Austin, San Antonio mega region? And if so, how should investors be thinking about that corridor today? What are maybe some of the places that are not getting a lot of visibility that you think should get visibility? Like we talked a little bit about Kyle. We talked a little bit about maybe Georgetown. We talked a little bit about that. Give me some of these areas, these, say, tertiary markets within a primary market of Austin and San Antonio.
Again, I think, if you just go drive I-35 and it takes you twice as long to get to your destination, that's not a bad thing if you're in the real estate industry. You can see the growth. It's a heat map of activity. If driving from Austin to San Antonio, or even now out towards Seguin, which is another market I've maybe put on some people's radar in terms of that's maybe kind of getting not overlooked, but just has some opportunity. So New Braunfels, Kyle, San Marcos, these are submarkets that used to be kind of dependent or little sister communities of Austin or San Antonio, but now these are their own individual markets, right? You've got a booming healthcare presence in Kyle. You've got obviously Texas State and San Marcos, and New Braunfels and San Antonio are almost just one MSA now. You do have some supply to contend with in all those markets, because I feel like that developers caught on to that 2-3 years ago and built a lot, but the growth and fundamentals are still there. So if you can find something maybe that's B or older look property in those pockets, I like the fundamentals a lot in that Central Texas corridor.
Talk a little bit about supply. I mean, that's been a challenge in Austin, seemingly kind of a similar challenge in San Antonio. I mean, a lot of these builders haven't found a property that they could make work on an Excel report, and now they're in the middle of lease up and they're giving away 8-9 weeks of free rent concessions in the marketplace. We sell a lot of properties. You guys sell a lot of properties that we do financing, a lot of properties that have already been built and been on the ground for 10 years or 20 years, are competing against these brand new inventory properties that are coming up with maybe some better amenities than something was 10, 15 years ago. What's your advice to some of these sellers or even these buyers having all this inventory on the ground?
Yeah, no, it's short-term pain, right, due to supply, short-term pain, but long-term gain, right? I still think now is an incredible time to be a buyer. It's the contrarian play. So look, on supply, right, Austin, we've got about 18,000 units still under construction. San Antonio is just under 6,000 units under construction. But in both those cases, it's an almost 70% reduction from the peak back in 2003 timeframe. And then absorption is keeping up with supply. 15,000 units in San Antonio absorbed in the last 12 months and over 30,000 units in Austin. So we're still digesting that supply, and we're seeing it on the fundamentals. And there's unfortunately a trickle down impact, right? So the brand new Class A property is offering 2 to 3 months of free rent. So the Class B renter moves up to the Class A property, and then the Class C renter moves up to the Class B. And at some point, somebody gets left holding the bag at the property level, and there's it's just tough. It's competitive all around.
Yeah. So I've been, look at a lot of supply and kind of like, scared where the puck's going, and looking at San Antonio, where the fundamentals are relative to like the cost to build a new multifamily unit, specifically San Antonio, this just doesn't make sense. So kind of looking, kind of where all this new supply that's been delivered started, over 2-3 years ago. And kind of, I don't think I've seen the most recent third quarter number, but I believe the first quarter of this year, there was like one market rate project for like less than 300 units that started in the entire MSA. And the MSA is, 250,000 or more units, and talking, 2.6 million people or something like that in the MSA. And you had less than 300 units start, So then I'm sure second quarter is probably something similar to that, and third quarter is probably something similar to that, where essentially you're going to have, virtually no supply start. And then, kind of fast forward 2-3 years from now, when that one deal delivers, there's, no deliveries in 27, 28, at least, you're probably talking less than 2,000 units a year. Each of those years is what's coming up. And 26 will probably be down to like, 3,000 units or less, I think, in 2026. And we've been delivering 10,000 units kind of year in, year out for a while down in San Antonio. So kind of put that in perspective. That's what's kind of coming around the corner here. At some point should put upward pressure on rents unless we just see a massive depression and everyone lose their jobs and stuff like that. So I think that's really kind of what it is. San Antonio has got a lot of topography, so a lot of the more desirable areas. It's expensive to build because you got to cut into the rock and, put retaining walls up and things like that. So it just kind of adds to the construction cost. So I think really it's just been a real challenging environment for every developer. So I know Paul mentioned at the onset of our conversation that we had the Old Capital Conference. You were down Newmark, had an event, which I got invited to, which I couldn't attend because I was at the Old Capital Conference down in Houston with kind of a bunch of, you said about 100 people, I think is what you said before we started talking, with a bunch of Texas owners and developers and people like that. Without naming names or anything, was there any kind of takeaways that you saw from some of the big owners and developers in Texas in that kind of room at the Houston Country Club a week or so ago?
Sure. And yeah, to the point on attendance, we were pleasantly surprised that the attendance and RSVPs exceeded our expectations. And so I think that's a good sign, turning point in the market. But yeah, I mean, we had owners, investors, developers from Texas and across the whole Sun Belt there. And say, from a couple takeaways from one large owner who's talking with institutional equity every day on the buy side is, from an underwriting standpoint, they are looking for, quote, durable income, right? So it's kind of what I'd mentioned earlier. It's we don't have no shortage of buyers, but they are buying the in-place property income. It's kind of almost boring in that regard, right? It's kind of back to underwriting 101 or real estate 101, where the in-place numbers and fundamentals are crucial to today's pricing and in today's value. And then, and additionally, there was, a large fund there who's got assets across all the major Texas markets, who is actively selling and buying and says, hey, we don't have a cap rate problem. We don't have a buyer problem. But yeah, fundamentals are soft across our whole portfolio. Fundamentals are soft. Concessions are higher than we'd like to see. Occupancy's flat. Lease-ups are going a little slower than we'd like. All that being said, it just goes back to supply. It's just what we've talked about. So we're kind of in just the short-term pain period, but there are green shoots, as we're all saying, the data is there. I mean, San Antonio alone, Michael, as you mentioned, starts are down to 80%. So we're really hopeful for the future, really hopeful for just the future of rental housing. We just haven't seen those green shoots show up yet on the rent rolls. But I will say, just my opinion, but once they do, I don't want to say it's going to be too late, but then, our business it's herd mentality, right? Particularly when you start talking about the larger institutional capital sources. So once we start seeing that meaningful rent growth, that meaningful concession burn off, the meaningful occupancy gains, everybody else will start to enter the market again, and it'll drive up pricing again. So I feel like now is the time to be a buyer. I really do. I know opportunities are few and far between, but to get ahead of the curve, I think now's a great time to be a buyer.
So, I mean, you mentioned a couple things I just took a note on, especially the Austin and San Antonio, Texas marketplaces. I mean, who's buying? Because there's a lot of buyers that want to buy properties, but there's a fewer amount that actually are closing.
True.
So without an idea, like a profile of a typical buyer / closer in the last, say, 6 months, is it institution? Is it family office? It is individual guys maybe are coming from California. Are there foreign investors? Go through your Central Texas book of business, so to speak. Who's actually closing on some of these deals?
I think the more dominant buyers in our markets right now it's family offices, it's discretionary capital, it's groups who have been around. Hey, I've seen this movie before. I've come out of 2009, 2010, and I bought in 2012 to 2015, and so there's groups who are taking advantage of that liquidity on the buy side, and so discretionary capital, family offices, private funds, but there's still very capable, quality syndicators getting deals done. And I would just say it kind of comes down to, just being in tune with your debt assumptions. kind of going into a deal eyes wide open. So yeah, on a smaller, and I say smaller, call it 20 million and under, or you're kind of, or 30 million and under, kind of standard B and C size deal. There's still plenty of groups out there who are using independent other people, on other outside equity, who are having to go raise that money, and they're getting it done. It's really just comes down to price and seller expectations. And so that's kind of the disconnect, right, where we are in the market in terms, Paul, to your point on very few deals actually getting closed. It's really less of a buyer issue. It's just it's pricing, seller expectations.
You've been doing this for a long time. You closed 17, $18 billion worth of business in this central Texas area over the period of number of years. And so you've seen these ups and downs. Give me your prognostication. If we were at the racetrack and the horse is just starting off, somebody that's a new investor, what does the market look like? Because we're in 2025. What's it look like in 2030 in Central Texas? And would you be able to kind of define what that looks like in Austin or San Antonio or places in between?
Yeah, no, that's, oh gosh, long way out, right? Crystal ball, wish we had it. But I think, I think the Metroplex of Austin, San Antonio will merge, right? I mean, when I use the word Metroplex, right? Because y'all are in Dallas, Fort Worth, DFW, that's been a Metroplex forever. There's been a lot of comparisons to San Antonio and Austin as kind of that next Metroplex. So I think those two markets will merge. I really do. And I'm really bullish on just overall Texas macro growth. And, it's good to be in housing. It's good to be in rental housing, because I think the single family market's going to be broken for years to come. I mean, who's to know what 2030 holds? But I think certainly for the next 5 to 7 years, the rental housing market's going to outweigh the single family home buying market. So bullish beyond measure.
That's great. Michael, any final questions for Matt Michelson?
Yeah, just kind of, you noted that whenever the fundamentals improve, we see concessions burn off, occupancy goes up, concessions then will burn off, and then we see rental rates. I think that's kind of like the sequence. You can't drop concessions, so you get stabilized, and then so you get stabilized, and first thing you drop concessions, and then you push rental rate. That's what I think is going to happen, or history tells me should happen. So the moment we see concessions go away and rents grow 5% or 3% or whatever, stop going down and start going up, all these deals that are trading today, which are more in San Antonio, is easier seemingly from my perspective to buy deals in San Antonio than it is in Austin, because these deals in Austin, there's Austin's more thought of as more dynamic, higher income, higher growth kind of market. It's just been dramatically oversupplied. And so, we're looking at it, there's very few deals, and it seems like there's a scarcity premium being paid where, like, you're saying it's in the 4s on the cap rate. We're trying to get to neutral leverage going in, or almost neutral leverage going in, and someone's like paying 25 basis points too low of a cap rate, in my opinion, the last couple of years or so. Where San Antonio is a little bit easier to kind of make that math work, at least on the SPI model for breaks. But when we do see the 95% occupancies, concession go, and 3 to 5% rent growth, that prints in 27, let's call it, pricing gaps up, 10%, 15%? I mean, because these are all well below replacement cost. So You got that metric.
Yeah, I agree. I think we'll start seeing some of that recovery at the fundamental level, hopefully back half of next year, but certainly going into 2027. And then from a pricing standpoint, let's hope that's 10% plus, 10 to 15% plus value creation, because, we've seen just in the last 3 years, almost 25%, 30% reduction in pricing. So, we're not going to make up all that in 2 years' time, but I think we'll make up hopefully at least half of that.
I guess my point is that, these are all trading, for replacement costs on generic suburban San Antonio Class A garden product is, $210 a door ish. I don't know, give or take. You can argue higher or lower depending on location and specific property, and you're selling those, and we're buying one right now for $172 a door. It's very nice, well amenitized, next to Costco and Walmart. And it's, we're pegging replacement cost about $210, $215. So, 40 below replacement cost, give or take. And, when the fundamentals kind of recover, we'll put 35% down at the value, 35% down, and the values recover 10%. I mean, we're making 40% kind of overnight on on our equity with a 10% recovery in value, right? Something like that, plus whatever cash flow and everything else and future growth and, all those things that will compound for there's limited supply. So, we make that kind of overnight and then, with limited supply, rents go up. Hopefully the inflationary expenses are down. Taxes have been a real problem last couple of years, so as all our values have been going the wrong way since the kind of middle half of 2022. The tax man keeps like hitting me with more and more tax increases, and we finally, I think, have seen that tide stem here in the recent months. But the tax man's always lagging, right? So like I think we'll see value start recovering and taxes kind of go down. And I was kind of reflecting back to the run that we had here recently, the prior run for the 10-year bull run, while we're all sitting here talking, that part of the flywheel that really made these values go up was that values are getting popped and then the taxes just weren't catching up. So we're, Matt's probably arguing to buyers, well, should you underwrite 70 or 80% taxes of purchase price, where now every deal Matt's pitches is like, well, let's take taxes down to 100% because it's assessed at 125, 130% taxes, and he's going to underwrite to that. And then Paul's, as a lender, is going to get the bank to underwrite to 100% taxes, where Paul, like 10 years ago, you were arguing between 80 and Paul between 80 and 85%. Does that sound right?
Absolutely.
So then that pushes the leverage that he can get and then makes them pay a little higher price for the property that Matt sells and so forth and so on with the rent growth. So, those of us that haven't been around or saw that story, I mean, it really, these taxes in Texas, I mean, it really will kind of put some gasoline on the fire once we see this great reset that's happening. These values are all kind of coming down in real time. When rents grow, revenue grows with lower vacancy and these other expenses kind of stabilize. I mean, it's really going to kind of get that flywheel going again. And with the limited amount of supply, I think it's going to, really kind of take off for, multiple years. I don't know if we got 10 years running, that's like we did last time, but anyways, those are just some I really wanted to question Paul. Some random thoughts I observed and was thinking about as Matt was talking. So I agree. Obviously, we all tell ourselves the same stuff because we wouldn't do what we do if we didn't believe it, and you couldn't take the risk or the effort if we didn't, truly believe into this. So, I mean, I'm a believer there's a backside of this, and, it's darkest before the dawn. And I think we're kind of past the bottom in, Class A, and maybe we're kind of bottoming now in workforce, and those with the courage of the convictions to go take action should be rewarded. And it's going to come a little quicker, a little faster than I think everyone kind of fears, because we're kind of got that recency bias of 3.5 years of pain. And, it's hard to be positive when everything around you sucks. Anyways, that's my little pep talk, Paul. If you want to chime in, either of you, that's all I got to say.
Yeah. Just keep going. I love it, Michael. I love it. Matt, any final comments before we close it out?
No, I really appreciate Michael and Paul having me on. And again, I just would say we're in great markets across Texas. So I would have faith, take heart, as Michael mentioned. If you have the courage to buy in today's market, I think now is a great time to be a buyer, because the future is bright for multifamily in Central Texas and the broader Texas market.
It's freaking hard to buy too, Paul. So like it's 5 years from now, everyone's gonna say, "Oh, if I only would have done this," but it's freaking hard to execute. I can tell you that. There's a problem every time you turn around. So those that do should be, very proud of themselves in the future when they make money. So that's what I keep telling myself, like Matt said. So, but Matt, if anyone wants to kind of get information on you, find future opportunities, see your future listings, what's the best way to kind of get on in your database and contact you?
Yeah, you can just email me directly at matt.michelson@nmrk.com, short for Newmark. We could add you to our distribution list. Always happy to pick up the phone and talk to folks and meet new buyers. Yeah, Matt Michelson, Newmark, San Antonio, on the website. Happy to be a resource, happy to add you to our list, and would love for y'all to come to our markets.
Can you spell that really for somebody as dumb as I am about how to say Matt Michelson?
Matt. So MATT, Matt.Michelson, MICHELSON @nmrk.com.
That's Matt Michelson with Newmark in Central Texas. He handles everything in Austin, San Antonio, in the Metroplex between the two large cities in Central Texas. So, Matt, thanks for being part of the discussion today. We certainly do appreciate that. The governor of the great state of real estate in Texas, Mr. Michael Becker, thank you very much. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.